We are all aware that we're living in unprecedented times. The impact of COVID-19 on global markets is far from over, and we will continue to see its impact on industries and regions in global markets for some time going forward. In an uncertain environment such as this, stock picking and knowing exactly what global markets to be invested in becomes increasingly difficult. This is where having access to exchange-traded funds or ETFs is very useful. ETFs are simply a basket of assets that track an index. They're typically stocks, commodities, bonds, etc., and can cover multiple jurisdictions, geographic regions, industries, strategies, etc. So with the purchase of one ETF, you can get an incredibly broad range of exposure and diversification. We've seen significant growth in the exchange-traded product market in the last few years, with around 80 different ETFs listed in South Africa, and 30 of these currently reference foreign assets. There's also a vast range of offshore referenced ETNs available on the JSE, from single stock exposures to global baskets. So using locally listed ETFs and ETNs that reference foreign assets is a simple and effective way to add offshore exposure to your local portfolio. So who would buy these foreign referenced ETFs and how would you use them? ETFs are actually used across the client spectrum and are suited to all investors, including retail investors, advisors, fund managers, DFMs, and large institutions. This is because they're very easy to access and efficient, low-cost vehicles that can be bought and sold in virtually any size. When constructing a diversified balanced portfolio, you typically want to include an offshore component. Using a foreign referenced ETF makes sense as you know exactly what you're getting, so you can allocate the offshore portion efficiently and effectively, ensuring that you get your required benchmark. You don't need to go through a rigorous active manager selection process or open offshore accounts to purchase this component. ETFs are very easy to trade, monitor, rebalance, and most importantly, low in cost. So this will have a direct contribution to your enhanced performance of your portfolio. So what type of index and ETF could you look at for this offshore component? It's always important to understand the architecture of the underlying index that the ETF tracks, so you know exactly what you're getting. The simplicity of a market capitalization index is very attractive, as market cap methodology is universally understood and easy to explain. With this methodology, the index components with a higher market share will receive a higher weighting in the index. So as a stock's increase in value, so does its relative size in the index. Currently, the world's largest ETFs track market cap indices, with the iconic S&P 500 being the index for the world's two largest ETFs. Ashburton's Global 1200 ETF tracks the S&P Global 1200 Index, which is a composite of 7 underlying headline indices, including the S&P 500, the S&P Europe 350, and the S&P Topics from Japan, amongst others. The index captures 70% of the world's market cap, covering 7 regions and 31 countries, and provides exposure to over 1,200 stocks across the globe, so it offers a huge amount of diversification. There's a large component in developed markets with exposure to some of the largest and well-respected companies globally, but also includes a 6% allocation to emerging market countries, including China, South Korea, and Taiwan, amongst others. Although the emerging market exposure is relatively small, a market cap index will ensure larger exposure if and when those markets show outperformance. In a post-COVID recovery phase, EM exposure would be considered an important part of a well-diversified portfolio, as we expect to see good returns from these markets in the midst of global growth reacceleration. Due to a 60% allocation to the S&P 500, the index still has significant exposure to the mega tech stocks that have driven much of the global growth in global equity markets, with names like Apple, Microsoft, and Facebook featuring in the top counters, but also has a relatively low concentration risk relative to the S&P 500. A really nice feature of this index is the underlying regional allocations that are very easily identifiable. So if your view is that you're underweight a certain region in your portfolio, for example, Asia, you can identify this and supplement your portfolio quite easily. The fund also serves as a good rand hedge for South African investors, as the product return is a combination of the underlying asset performance plus the USD ZAR performance. And at a management fee of 0.25%, it's a cost-effective way to include offshore exposure in your portfolio.